But let's talk about Thermax, which reported a very strong set of earnings. The company registered a revenue growth of 20%, led by the industrial products business, which is 23% of the business, and the infrastructure segment. Green solution segment has also seen a 72% surge year-on-year. Ashish Bhandari, who's the MD and CEO of Thermax, joins us now to talk about that. Mr. Bhandari, thanks a lot for joining in. Can we start with the industrial infra business, right? It contributes highest to your revenues, but it has the lowest margins. Any headroom for improvement in this particular segment?
Good morning, and thank you for having me on the show. Yes, there is headroom for improvement, and based on the profitability of the industrial infra, substantial room for improvement. This is the portion of our business where we do EPC projects, and especially on larger projects, our history of delivering profitability has not been as good as we would like, and which is why there has been a focus on taking measured growth in this area and focusing more on profitable orders coming in, which for the past few quarters has not been that easy. As we get into this year, one of the areas that we would like to improve on is getting more large orders. There is some visibility, and making sure that these large orders are profitable and additive to Thermax.
Okay, so this industrial infra business, right, your EBIT margins have been in this range of 6%. I mean, in this quarter, you saw about 6.08%. So when you say that there is more scope to improve, can you get to double-digit margins, say in FY25, FY26 for industrial infra particularly, or is that too tall an ask?
I think FY25 difficult, but as we go forward, maybe not double digits, but definitely much better than the numbers that we have currently. And as I said, I would also like to see more growth coming in from this area. We have had now a few quarters of not as many large orders coming in. So FY25 and 26, I would like to see that order book on large orders also improve.
All right, Ashish, morning, Prashant here. And that's interesting because I remember last few interactions, you've been saying how, you know, this it's smaller orders, but I mean, it's coming from so many different sectors. It's more varied. And in that sense, but is that a good thing, Ashish? I mean, large, lumpy orders are kind of prone to, you know, smaller, more disaggregated order book is always better?
I'm not asking one or the other. I'm asking for both.
You're asking for both.
For both, yeah. And which is our industrial products business, which is a lot more diversified, multi-segment, multi-industrial growth. There you can see we have had steady uptick, and that's the story we've been pushing. Services, consistent growth, and we've been delivering that. That portion of the business has improved on profitability as well. A couple of our international businesses are also better than what they've been in the past. We would like to see that trend continue. On the larger orders, we would like to see some uptick. And I'd said that, yeah, especially refining and petrochemical, which is the single biggest contributor, we haven't seen much. But as I get into this year, we see a bigger pipeline, at least in steel, in power, and then refining and petrochemical also coming back.
You know, we were earlier speaking with another company on the shipping side, and they were talking about the rigs and offshore vessels, etc. And they were talking about the Saudi ramp down. L&T, for example, is somebody we spoke to last Friday, and they also spoke about their Saudi exposure. Of course, that's very large for them. You know, just is there any impact across your various businesses because of what we're likely to see in Saudi and Aramco and, you know, that city which was being built out, etc. And just talk to us about, in both your sort of industrial products and green solutions business, what is the amount of deferred orders which were perhaps delayed for finalization, etc. And you know, what you expect to close here in these segments in Q1?
I can't give you Q1 look, but I'll take all the rest of your questions one by one. International and Saudi, for us, our exposure is low. If anything, I would like our Thermax to have better presence across the Middle East and Saudi in particular, where there is, in some ways like India, a multi-decade growth which is possible in kind of products that Thermax is is better at. Yeah, we're not in upstream rigs, etc. Our focus is more midstream, downstream kind of industrial growth. And there, I think we can do better in Saudi, and growing Middle East in particular is one of the areas we would like to see more of. Currently, our exposure is very minimal to Saudi. Yeah, that's one part. Sorry, you had a follow-on question? No,
Go on, Ashish.
So on the second part, which is how do I see kind of the larger growth across multi-segments, multi-things across India? Am I seeing based on kind of order push-outs, etc.? There have been order push-outs, especially in a couple of segments which are relating to ethanol, sugar, biofuels, bioenergy, some in the steel industry as well. I don't have a specific number to say because we always have some where the customer is shaken hand, but the order is not placed for one reason or another. In this last quarter, it has been more than maybe in previous quarters, possibly because of people wanting to see how the elections turn out, etc. But I do expect once some of this is over with, some of that pickup to come back in.
Okay, all right. Good morning, Mr. Bhandari, and good to see you in. Well, give us a few more details. How do you expect the mix to continue, with regard to domestic and exports? What is it at? And how do you see that panning out? And a quick question on margins as well. Do you think double-digit margins is doable for the coming year, given that input costs, a lot of metal costs have gone up big time? It could be a pass-through, but in the near term, it could cause some bit of a pullback.
So let me take both questions one after the other. First, on international, Thermax historically was higher on internationals. Actually, at one point, it was even 1/3, 35% of Thermax's business. Over the last few years, the domestic growth has been much higher. As a result, exports have come down to 20-odd% of our business, depending on the quarter. Exports are profitable for Thermax. They're good business. And in this year, I expect the exports part of our business to start growing again as a percentage of Thermax's overall business. We have a good pipeline, a better pipeline than in previous years. And we expect better orders as a result. That was our first question. On the second question on what should we expect on margins overall as we look into this year, there is commodity pressure. There is also pressure from having to build out many of the new energy areas, which will require money to be poured in and some amount of short-term hits to be taken as we look to establish those businesses. Our bio-CNG business being an example. So in that sense, I don't think a double-digit profitability is a target. I think in every business that we work in, the hope is to, and the expectation and the work done is to continuously work on improving our competitiveness, improving our margins. But a net number, which is all integrated Thermax, is actually not a number that I target internally either. Yeah, the focus is on growing each business, being competitive and continuing to go up the competitiveness curve and continuing to improve.
Mr. Bhandari, let me thank you on that note. Sorry, we had to interrupt because the market was sliding a bit. I just wanted you to leave us with one number, which is on the borrowings front, because the borrowings have risen to almost 800 crores right now. What is the debt level that the company is comfortable with over the next 1 year?
Look, we are very, very conservative as a company. Most of this borrowing, actually all of this borrowing, is for setting up the renewables part of our platform, where the borrowing is done at an SPV level without any corporate debt and corporate books, recourse to our corporate books. The Thermax legal entity, which is TL, that will continue to stay debt-free, and the debt that is being taken is specific to those assets, specific to those SPVs with very strong financials as per industry norms for the renewables business. So Thermax will continue to be very, very conservative and at the larger level, completely debt-free.
All right, Ashish, we'll leave it there. Great conversation. Thank you very much for joining us. And we look forward to speaking with you again as you bag those larger orders, as you said. There's greater visibility for them. You'd like to get more of those larger, chunkier orders in FY25.